And that guest is Lacy Hunt. He helps manage $5.7 billion at Hoisington Investment Management. He's also the chief economist for the Wasatch Hoisington U.S. Treasury Fund. That's beaten 98% of its peers, not only this year, but also over the past 5 years. Lacy's joining us from Austin, Texas, where he's based. Lacy, thank you very much for joining us. Obviously, a lot of people weighing in on this Fed operation, so it's good to hear a lot of different voices on it. Why do you think it's going to be successful? There are a lot of economists and investors out there who are not necessarily buying into that argument today.
Well, this is having the exact opposite effect of quantitative easing. When the Fed did that, we saw tremendous speculation in stocks, commodities, and the dollar sold off. There were some on Wall Street that benefited, and commodity speculators benefited. But the net effect was that we had a considerable surge in inflation, which flattened the budgets of millions and millions of our households, and which are today the cause for why the economy is deteriorating. And so by taking this action, the Federal Reserve actually will serve to reinforce the uptrend in the dollar, reinforce the downtrend in commodity prices, and allow the after-inflation income of the typical American household to begin to improve. And so what the Federal Reserve has done here is to select a mechanism. In other words, income. Income is one of the most powerful concepts in economics to begin to turn around, and it won't work miracles overnight. The country's in a deep hole. We're deeply indebted, but this is an action that moves us at least in the right direction.
Well, Lacy, I would ask you, though, at the same time, the Fed's stated intention is not necessarily to bring inflation down and to bring real incomes back in line. It's more to bring rates down at the long end of the curve, perhaps to spur folks to refinance their homes, and perhaps even to spur new home buying. And a lot of the naysayers have been saying the demand is just not out there at whatever level you see rates. What about that effect that the Fed is looking for?
I don't think that it will result in an upsurge in borrowing in the present environment. But the job of the economist is to understand the intended consequences, the unintended consequences, and try to draw a conclusion as to what is the net effect of the action. And I think that maybe the Fed didn't intend it this way, but the result of what's transpiring and what we at Hoisington think will occur over the next year or so is that real incomes will gradually begin to turn around, and this will be helpful. It's not a sole panacea because we've got all kinds of debt problems. We've got fiscal policy that's on the wrong track, regulatory policy on the wrong track. But this is a modest step in the right direction.
Now, you say you're looking out over the next year here. And as you mentioned, of course, the effect today is, as you say, the dollar rising. Two-year yields are bumping up a little bit as the longer end of the curve, the yields are going down. But do you think that's an effect that's going to be sustained, especially when there are so many exogenous factors, including what's going on in Europe and some of the other economic and corporate factors that are going on here in the U.S.?
No, this action by the Federal Reserve is a modest step, and really the Federal Reserve is, for all practical purposes, out of major bullets, and so they're really not in a position to take actions that are universally beneficial. And so the net result, a good policy in the current environment where there's all these constraints, is to take an action that helps the most people. And I think that that's what this does.
Lacy, just in our last 30 seconds or so here, you, of course, help manage treasuries for the most part. What are you guys doing right now? How are you positioning yourselves?
Well, we've been very negative on the U.S. economy. We think that the real underlying cause is the excessive indebtedness, and that indebtedness decreases your options, makes you weaker, more vulnerable, and we've been positioned for that. Our fund and our institutional clients have about a duration of about 18 years. And as long as this difficult economic environment remains, we expect to continue with that very aggressive posture in the long end of the Treasury curve.
Lacy Hunt of Hoisington Investment Management joining us from Austin. Thank you so much for your time, Lacy. Appreciate it.
Great to be with you, Julie.